Thanks, Bill, for the question, and thanks, AI, for inviting me to share my thoughts on U.S. investors investing in sub-Saharan Africa. We started Kuramo Capital 2.5 years ago with one goal in mind, and that goal was simply to help a select group of high-quality investors capture what we believe is the tremendous growth opportunity in sub-Saharan Africa. We came to this from my background. Bill mentioned to you, prior to starting Kuramo Capital, I was a CIO at RPI, Rensselaer Polytechnic Institute, upstate New York. And my charge at RPI was to help diversify the portfolio globally into regions of the world that were growing really fast. And so after investing in China, India, Latin America, and some Vietnam, and actually a little bit in Russia, we looked around the world and said, well, the next fastest growing region is Africa, sub-Saharan Africa in particular. We asked two questions we asked ourselves when we went to China, India, and Latin America. One was, A, could we find talent and managers that have the same characteristics as some of the best managers that we have here in the US? While I was at RPI, we were fortunate that at least in our venture portfolio, we had investments with the likes of Sequoia, Matrix, and Kleiner. And so by hanging around those folks, you got to know what the best looked like. And so going out to China and India, we were looking for firms that had the same characteristics. The second set of characteristics we're looking for was just a local network. And we felt that as soon as you start moving away from an area where you really feel comfortable, like the US, having that local network is very, very critical. So we did this, and by the time I left RPI, we had committed close to 5% of the endowment and pension plan across asset classes in sub-Saharan Africa. So this is what we're offering our investors now at Kuramo Capital. We're agnostic in terms of what kind of asset class it is, whether it's private equity or it's public equities. However, though, we complement our work with in-depth research. We look at a number of the stock exchanges in Africa, and we realize that the market cap relative to GDP hovers around about 15 to 20%. So in our fund, we said we'll have a limit of about 20% in some of the fast-growing companies in what we call the 3Bs, the banks, the brokers, and the builders in sub-Saharan Africa that make up about 70% of the stock exchanges. The fact is, the really fast-growing sectors, telecoms and fast-moving consumer goods, you can only find those in the private equity landscape. So our fund will be about 80% private investments going forward. But like I said, we are agnostic. Our goal is to generate returns north of 3 times for our select partners, and we can do it in private equity, we can do it in real estate, real assets, resources, or public equities. To your question about what does it take for conservative investors to get comfortable about investing, I'll say 3 things, frankly. One is finding a very credible partner, a partner that you can trust, that understands the landscape, and a partner that has been vetted successfully in developed markets, right? So what we bring to the table in Kuramo is the fact that we've invested successfully in developed markets, and we've invested successfully in emerging markets. So we just don't know Africa or frontier markets. We can benchmark funds that we see on the ground in Africa relative to the best in developed markets. So having a credible partner is key as the first thing. The second thing is that partner has to be on the ground and has to have that local presence. As you start moving away, I mean, we're doing sub-Saharan Africa, 48 countries, and trying to get your arms around them can be tricky. So having that local network is critical. For us at Kuramo, all the 3 partners grew up there. We all went to high school on the ground, and that's where you build your local networks, unlike what we have here. And that's so critical. And it so happens that at this age, I guess the gray hair helps it, that a lot of our peers are captains of industry or running government positions, so we do have access, which is very, very, very critical. And then the third thing is a diversified approach to help you mitigate the risks on the ground that you just can't account for. When we look at direct investments, which we can also look at Kuramo, our goal is that if we don't find anything that's going to give us 5 times our money back, we don't even start the conversation. And people will say, wow, 5 times sounds like a lot of very high return expectation. But the truth is, you have to give yourself that margin of safety just in case anything goes wrong. So 3 things, having a credible partner, a partner that's on the ground and has strong local networks, and a partner that will give you a diversified approach into investing across regions, across managers, across sectors, and across industries is a great way to get people comfortable with investing on the ground in Africa.
Let me just follow up on the diversified approach. When you do your own, within your fund, your asset allocation, do you also have certain diversification parameters by region, by sectors, and how do you analyze that?
Yes, we do. So we go through quite a bit of work trying to understand the capital markets and the opportunities in various parts of the continent. So for us, if you look on the West Coast, the primary countries obviously are Nigeria, Ghana. You start moving a little out to Senegal, Cote d'Ivoire. But Nigeria just so dwarfs that market there, and so for us, we have an allocation which is pretty high that says we will not exceed 50% in Nigeria. And then if you come over to the East Coast, Kenya dominates that in terms of GDP and in terms of opportunity as well. And so we have another 30% allocation to Kenya. As a max, is what we're saying, and then the rest falls with any of the other countries in sub-Saharan Africa.
Thank you very much. Thank you very much for the thoughtful approach and how you choose your fund managers. Maybe shift a little bit and talk about, let's get down to the brass tacks of how we look at managers or investments on the ground. All of us here are practitioners. We've been kicking the tires in funds or direct investments in most of our careers, whether it be in Africa or other parts of the world. And I wanted to throw out the question to anybody in the panel is there anything that you do differently if you're looking at, say, an example of a fund investment, new GP, even maybe not new, maybe on his or her second fund, how do you evaluate? Do you look at any differently in the Africa context vis-a-vis a private equity fund, let's say, in Southeast Asia or Latin America? Cultures aside, which I know is very important, and as well as the local presence, trying to get a feel from anybody on the panel, is there anything distinctive about Africa that you could share, African private equity GPs you could share with the audience? Wale, since you do a lot of funds.
You don't do anything different from what you do in developed markets in terms of looking for managers. The business is all about people. And really getting comfortable with the people and their track record and their ability to deliver for you going forward is a key thing. However, a key thing, and I think it's not just unique to Africa, it's unique to all emerging markets, it's what I was alluding to earlier, which is that local network. What that local network does for you is the ability to reference check people 360 degrees, up and down, all kinds of ways, right? Like, look, if I'm looking for a manager in Nigeria, and because if I can't find him from Monday to Friday, I can guarantee you that on Saturday somewhere I'll find him at a wedding or something. If I can't find him at a wedding on Saturday, I probably will run into him at church on Sunday. So that's critical. Being able to vet people in all kinds of ways is the added thing that you bring to when you're looking into emerging markets. Because the key thing you want to do is you don't want to make any mistakes. You're looking for credible people that have that on-the-ground presence, and and they've done this before. I mean, what's encouraging, and I think what we find generally, is the fact that you're seeing a good wave of people, managers that have cut their teeth, generally here in the U.S. or in developed markets, that are moving back in droves and now want to hang out their own shingles. So that gives you a good way to track them and to reference check them. But the key added thing that you have to do is reference checking a little more in depth than we will do here.
Doing business in Africa, you can't afford to be without Africa Investor.